Is it really all about the 3%?
It's interesting because there's positioning around the 3% level. You got 295, which is what we hit yesterday. Big sell-off, hit 295, and bounced right back from it. So that's a level to watch. And then the psychological 3% is what everyone's going to be focused on next, because when it comes to fixed income, having round numbers, means a lot. You just saw 225 on a 2-year auction earlier this week, and everyone was, on a buzz on Twitter. We finally got that 225 coupon, which we've been waiting for years.
The chart 9600 showing you some other crucial levels past 3%, which is around the high marks from 2011. When you look at open interest on the 10-year yield, where are the puts and what are dealers telling us?
Yeah, exactly. So it's that 295 level that there's so much open interest around that to break through that, we're probably headed to 3% next. So at the close yesterday, it looked like we might get there in the Asia session, but again, we bounced back from that. And then once you get past 3%, it's really an open question where we go from there. 310 maybe, and then progressively further.
What will it take for somebody to say the 30-year bond bull market is over? I mean, I know many people say it already, but what constitutes that being over?
It sort of depends on how you define it. I've heard some people say, 3 straight months of negative returns on your bond portfolio. People start to say, wait a minute, bonds are supposed to give me safe income. I'm supposed to, have a positive return no matter what. It's not volatile like stocks. So that could be a signal, and I think that the 3% mark is what Jeff Gundlach and Scott Minerd have talked about as a level that we might break through there and then just go higher.
And also, what does that represent for the stock market rally? Is it also the end of that?
That's the other question. We saw this tug of war play out earlier this month when stocks had their big decline. A lot of that was blamed on higher yields, faster inflation, but you got a good inflation print recently, and stocks are still doing fine. They've recovered. So it's an open question about at what point will this start to really inflict pain on equity investors.